Hey everybody, welcome to Trading Capital's weekly sector analysis. Today we'll be discussing all of the 11 sectors of the S&P 500 and what you need to know based off of capital rotation trends and where likely money flow is going to be heading to. So starting off with technology, XLK. Overall, the technology sector finished just slightly up on today's or this last week's session, up 0.36%. Now the XLK has been outperforming the overall S&P 500 and the majority of the other sectors. Right now, in terms of the year-to-date performance starting from January 2023, XLK is currently up 19.79%. It is the second leading sector of the S&P 500, and it obviously has some of the behemoth names inside of its indices, such as Apple, Microsoft, Nvidia, which is really where the concentration of money flow has been going. But overall, this technical price action, you can see that the institutions and market makers have defended the weekly 200 moving average, and you've basically been making a series of higher lows. You have your low here, you have a higher low, another higher low. Now the big question is, off of this consolidation and this price action, due to the resistance levels that it is trading into, you can see this beautiful COVID trend line, which we're bubbling up against. And then when you factor in the resistance level that technology is into, you have this major pivot high, that's 2 weeks of trading. You have this major gap down breakdown zone, that's another several weeks of trading. You have this major pivot bounce over here, another breakdown zone, that's another several weeks of trading. And then you go back in the trend and you have a few more several weeks of consolidation before breaking out to your all-time high. So this is a very, very congested area. XLK will need to consolidate. Basically, having a 3-week move, 1-week consolidation bar is not enough. The big level that people in terms of going long technology want to watch for is a weekly close below this pivot high. And then obviously if you can establish a weekly close above this pivot high, then that's obviously going to be a little bit more bullish. But my base case, this is going to see lower consolidation price action. The question is, will we maintain the trend over here? Basically, this is your little bit of a wedge pattern that is starting to form with your series of higher lows. Now keep in mind, you still have a major series of downtrend in this particular sector, but the bullish aspect is you're above all of the long-term weekly moving averages. And one can now watch on the long side, what type of pattern do we get? Do we get a nice bull flag consolidation where we have several weeks of sideways price action? If you get several weeks of sideways price action, there will be a whole host of opportunities in the technology space to go long. But you really don't want to start pushing too much further too quickly, because this can get extended and overbought, and it's not really going to be a healthy move if you keep just making this very, very steep incline. So my base case is you can probably chop sideways, but you really don't want to lose this little bit of a reversal pivot where you had your moving averages meeting in confluence. So that's kind of what I'm looking for technology. Now, if we look for the next sector, healthcare, it's been pretty evident what XLV healthcare has seen. We were bullish on healthcare. We were prepping you that if you were likely going to play a sector, you would see capital rotate into XLV, and we said that it was oversold, likely to get a bounce. Now, healthcare is overbought. This is a stellar move for healthcare. I mean, just closing the week, it was one of the best performing sectors. I actually think it was the best performing sector. Yes, it was. It was up over 4.24%, so it outperformed all other sectors last week, and it was a clear money rotation, capital rotating into some of the defensive names. And basically now you have recaptured all of the weekly moving averages, so that is short-term bullish for healthcare. However, it is overbought. You really want to see consolidation, but you really want to hold this wide range green bar now. The only downside is that healthcare's move has been on decelerating volume, which means that there are a large amount of buyers being exhausted at this area, and it will need to consolidate just like technology. Now, typically when you see money rotating into healthcare and healthcare outperforming the market, that's a little bit of an inside signal for the market participants to just use caution, as money and capital is rotating into some of the defensive names in healthcare that provide a good yield, provide a stable business model, and ultimately provide the necessities that people are going to have to continue to take and need. People will always need their medication and treatment plans, and specifically in a boomer retirement cycle and aging cycle, definitely healthcares have a tendency to see money rotating into when there's a little bit more risk coming or being forecasted in the near term. Now, let's move on to XLY, which is the Consumer Discretionary ETF. XLY is an interesting chart. It's a little bit of a tricky one to digest, but ultimately what we have going on here is a whole confluence of moving averages. You basically are below the 100 week, you're also below the 200 weekly, and you also got rejected at the 50 weekly moving average. So those three signals right there are super, super bearish and very, very powerful to dictate the overall trend. You can clearly see higher lows, lower highs, lower highs, lower highs, lower highs, lower highs, and it's looking to be that you've tried having this epic bounce to recapture a potential breakout of this little bit of flag pattern. However, based off of some of these red bar, wide range bar closing below some of these key impulse moves to the upside, there's a lot of resistance. There's a lot of sellers in this XLY ETF, and we just have to be mindful that we could run into some near-term pressure if we don't capture these key moving averages. In terms of the year-to-date performance, XLY has been holding up relatively better than most sectors. It is up on the year 12.21%, but in terms of its year-to-date performance, it is still it's the second worst performing sector in terms of a one-year period. It's down 22.88%. So definitely not really that much strength in this particular sector, and we really have to watch some of the specific names that hold large market caps like Amazon, Tesla, Home Depot. And when you factor in that this particular sector has not been performing well, when the likes of Amazon has been holding up a decent amount in the recent sessions, we just have to be mindful that there could be a lot of selling that is transpiring under the hood. Now, with the more oversold sectors, what you want to see is, can we get a beautiful consolidation pattern inside of this wide range green bar? As long as you stay inside of this wide range green bar and consolidate for a couple weeks, you will have a shot to break out of this downsloping trend line. And if you get a weekly confirmation break of this trend line, you do have potential, quite a bit of upside in this particular ETF, and we will look for definitely some long trades if we can see some meaningful consolidation in this particular sector. So definitely a lot of potential opportunities on the horizon. You do have lowering volume on the XLY, so perhaps that's signaling that buyers and sellers are becoming exhausted, which means that we may just chop sideways, which is actually beneficial for the consolidation patterns if we can chop sideways. But a clear downtrend, when a major downtrend is likely going to resume, and when you see the S&P and the Qs breaking key pivots but particular sectors are still lagging, you have to be definitely mindful of the relative weakness in this particular sector. All right, let's jump into the financials, because the financials are going to be very, very intriguing on this go around. Basically, the financials are going to be intriguing because we have bank earnings. Large banks are going to start to report in the coming week. You have JPM, Bank of America, and a few of the other large banking institutions that will be reporting. Now, financials have actually been underperforming the market. You can clearly see that you've had a bounce off of the weekly 200 like you did over here. But these moving averages are starting to slope down in vicious formation, and it's not looking good for this overall pattern. You've now had 3 weeks of opportunity to recapture. Sorry about my screen, just refreshed there. But you've now had 3 weeks, 1, 2, 3 weeks of opportunity to try to have a technical bounce off of a major support level and a very, very sharp rate of change move, but you've still stuck inside of this hammer reversal on massive volume. So that leads me to suspect that there's likely going to be more selling. Let's say that the bank earnings get a pop on earnings. I think that there's going to be still a tremendous amount of selling that you'll see. You know, maybe you get a short-term pop in some variety of names, very select few names, but I think that any sort of pop is going to be met with selling and distribution pressure just based off of this negative weekly pattern that is occurring on the XLF. This is starting to form a bearish wedge. If you simply just look at this little bit of a pattern here to basically this high over here, you definitely have a bearish wedge setting up on the XLF. And if you get more bearish weekly consolidation, you should slice through this weekly moving average. And I actually have a downside target of about 28, maybe a pierce of $28, basically back to these pre-COVID highs. And if things get really bad, maybe even lower than that. If rates continue to rise and net interest margins squeeze and get compressed in the bank earnings cycle, and and credit lending compresses as well. I mean, things could get really nasty very, very quickly, but you have to be mindful that you're just lost all of the key weekly moving average and you're putting in bearish consolidation. So buy the dip mentality in the stock market has been definitely at the forefront in 2023, but as seen here, not many of the ETFs actually, or the financials, considering they have a great deal of important publicly traded companies and institutions that run our financial sector, the buy the dip wasn't really that strong. And that is a sign of caution, specifically if there's risk in the overall financial sector. All right, let's take a look at XLC because that has been a very, very powerful sector as of late. The communication sector, you can see that it is at resistance. You're challenging this COVID trend line again, where you had your bounce over here, major breakdown, retest, rejection. Now you're retesting it again. The only thing that I'm skeptical about is you've had 4 weeks of a straight move into this major, major resistance level. Let's say that you do get through that. You also have the weekly 200 moving average that should be bearing down as pretty good resistance. Overall, the communication sector did finish up the week 3.86%. In terms of its year-to-date performance, it is up over 22.8%. So a whopping powerful gain. It is actually leading the S&P 500 out of all of the sectors. It's even beating out technology. Obviously, in communications, you have a lot of important names like Meta, which has definitely been a leading stock in 2023. And you also have Verizon, T-Mobile, Google, Comcast, Netflix, Disney, a whole host of names that definitely carry some importance in the overall global economy and definitely provide leading indicators to where the market is heading. Now, short-term positive, you've recaptured the short-term weekly MAs, but you're still below the two big ones, the 100 and the 200 weekly, and this yellow trend line. That's going to be the big line in the sand. Now, one thing I am noticing here is that you have traded a whole host of volume off of this weekly last candle. That is an epic surge in volume, and considering that the ETF did finish late, what this is telling me is that you likely did get a lot of short covering that occurred in this particular sector, and also a lot of buying pressure. Now, considering that this volume bar was it was a very heavy volume bar, and you really didn't make a wide range green candle that was bigger than the previous 2 weeks, but yet the volume was inflow, also tells me there's still sellers at this resistance level. So obviously it was a net positive week, so the buyers pushed it higher, but when you have a deep wide range green bar that really didn't make a larger green body candle than the previous 2 weeks that had much lower volume, that's a little bit of an indication that yes, there were buyers, but there were still big sellers at this technical resistance. Now, I am watching. I would love to see a little bit of a few weeks of consolidation before re-challenging a break of this key trend line. If you get a weekly close back above this trend line and start building a base above it, we could actually look for a long play in the communication sector and really potentially play this inverse head and shoulders pattern. Now, it hasn't triggered yet, but we have to be mindful that if this does trigger this XLC inverse head and shoulders, we're looking at a move above 70, 71 bucks, so that should have a lot of upside. Now, the only thing that leaves me skeptical about this particular ETF is the concentration. When you have Meta holding a 22% weighting, or just over 22, when you have Alphabet, Google holding over just under 13%, there's minimal stocks in this particular ETF that hold such a large weighting, and it skews it so ferociously. So when you factor in Google's done well and Meta's done well, one of the reasons you've seen a 4-week surge to the upside is because of such the concentration in two particular stocks inside of this ETF. So just be mindful that you're aware of the weightings when using these sector analysis videos to determine whether or not you should be going long, because even though this sector has had a lot of strength to the upside, there's still a lot of relative weak names when you factor in the move that this sector has had and when you factor in some of the individual names per se. So definitely be mindful of that. One thing I will caution is that if you get a rejection at this point over here, you have an upsloping wedge pattern that needs to be on watch, because if you get a break of this, say this upsloping wedge pattern, I mean, you could have a sharp fall down to the downside to retest some of the key support levels. So definitely be mindful about your resistance, which we're tagging right now in an extended 4-week move. and definitely be mindful of the support that if you break that level, it will not bode well for the overall sector and the S&P, considering this has been one of the leading sectors. All right, let's move along to the industrials XLI. So XLI is interesting. So XLI actually finished down 2.37% on the week. It was the worst performing sector. So we've typically been seeing the XLI being a run to safety. You know, a lot of the individual names in this particular sector have been holding up exceptionally well in comparison to the broad market. And with some of the harsh economic data that we got last week, I think it's these XLI, the industrials, are starting to price in a potential recession. And if they are, XLIs typically lead a lot of the other sectors like materials, as well as the energy sector. So we have to be mindful about what type of price action we're going to get in terms of follow through. And in terms of like some of the important stocks in the XLI, I mean, when you look at Caterpillar, John Deere, some of the ones that carry a huge weighting in this particular ETF, they were ones that really got hit hard. In terms of XLI's year-to-date performance, it is down 0.45%. So actually with this decline, it went negative on the year. Basically trading most of 2021, 2022 positive on the year, it's now gone negative. So when a specific sector has been leading for about 12 to 24 months, in most cases after getting harsh sell-offs and then rebounding, and now it's gone negative, we have to be mindful that this is a defensive sector, and when defensive sectors like this start to go negative because of potentially weakening economic data, they're reacting negatively. And I mean, the sell side pressure on this volume sell-off is starting to increase ferociously. You're starting to lose these short-term weekly moving averages, which is showing us that maybe there's still a little bit more downside, considering they're not really trading at major support at this moment in time. Now, a couple other things that I want you to keep an eye on is we keep getting rejected off this down-sloping trend line, and we keep bouncing off of this trend line. You're creating a wedge pattern at the highs of the charts. Wedge patterns at the highs of the charts are not typically highly probable for continued upside unless you get meaningful consolidation. Now, considering that this is looking to be a bull flag consolidation, if we start making a lower low in this consolidation like we did here, if we take out these lows, this could turn into a failed bullish consolidation pattern, which likely means there's a great shot of breaking this upsloping wedge pattern. There is going to be a lot of support if you break this 50 down at the 2 again, just like you had a ferocious bounce, but just be careful. If we start breaking this wedge pattern, it could mean that industrials are certainly under a little bit of pressure. In terms of the 1 year change in performance, industrials are down 2.71%. So again, showing negative trends starting to form. Yes, you're still above the key longer term moving averages, but just be mindful that if this bullish consolidation fails, and considering you never ever confirmed above this weekly hammer and it was just met by more and more selling, we have been mindful about this hammer reversal candle that happened on volume way back when, and we've been really watching it to see if we can get a break. And it just seems like every time we try to get above there, market makers and market participants push it right back down. Let's take a look at the next sector, which is the consumer staples, XLP. So XLP has had a lot of strength in the recent 4-week session, surging to a high. This one's a little bit surprising because you've actually had a lot of insider selling from the likes of Walmart, a very heavily weighted stock in this particular sector. Now, other stocks in this particular sector like Costco have been performing well, but definitely on watch for a potential big trend move in the near term. The year-to-date performance of the consumer staples just slightly positive, up 1.09%. In terms of the staples 1 year performance, they're down 1.49%. So it's basically negative still on the year-over-year data. Now you can see what's the technical picture showing for us here. Short-term positive, you're above all of the key moving averages, every single weekly one. The short-term negative, you've had a 4-week move, no consolidation, and you're at resistance. The big question is, are we going to continue to put in a higher low? Here you have your high, a lower high, and now we're going to put in another lower high. That's the big question. I still have it priced in for more downside in the consumer staples, but certainly they have been a sector that people have been fleeing to in times of market stress. And if we still see money rotate out of technology, this could be a beneficiary. But at this point in time, I can't chase this move higher because you're at a massive resistance level and you are having a declining volume trends, which showing that maybe buyers are running out at this point in time. And if the markets start to break down, you could see definitely sellers start to resume in the near term. Overall, though, it is holding up better than most sectors at this point in time, and it is above the key moving averages, so we'll just have to respect the trend, and we'll see if we get a little bit of consolidation, maybe about 3 or 4 weeks underneath this trend line, then you could have a potential long trade to the upside for maybe a double top quick move to the 79, maybe a pierce of $80, and then we'll have to reassess from that point in time. The next sector that is really important to watch, it is signaling some pretty important things, is utilities. So utilities are making a sharp move higher. And utilities were actually the better performing sector last week. They outperformed everything on the 1 week period. In terms of utilities performance, they were up 4.09. So sorry, they were just slightly under healthcare, but had a whopping move. And the thing about utilities, when utilities start to outperform the broad market, you better be on notice as a long-term investor, because what is the reasons people buy utilities? Well, for starters, they usually pay a higher dividend yield. And why do people look for dividend? Because typically dividend investors want that extra cash, and they flee to that aspect of the market when they're forecasting a little bit more risk in the system and potentially a downturn in the broad market. So if there's a downturn in the broad market, investors like dividends because it means they will still get paid no matter what, as long as that company still has their dividend on the line. So we're watching utilities now for a technical breakout. Often utilities will signal a market decline. Typically, there's a variety of different times in 2022, 2021 where utilities started to outperform the S&P 500, and that typically meant the S&P 500 was going to see a near-term downside move or some downside consolidation. And that's specifically what the markets actually need at this point in time as they run up into some key resistance levels. So definitely be mindful about utilities outperforming. There's some interesting trades if we get some follow-through on this move to the upside and then a consolidation pattern. Utility sector was very weak, but on the year-to-date performance, it's trying to climb back to the positive side. It's still down 0.98%, but just hanging on, trying to go positive. In terms of its 1 year performance, it is still down minus 7.4%, but clearly trying to make a move and recapture all of the bullish long-term moving average from this point in time. Again, there might be some potential long trades in the specific sector, but you really have to know what market and what timing, what part of the cycle are we heading into? Why is capital rotating into healthcare? Why is capital rotating into utilities as of late? And what do those typical capital rotations mean? Let's move along to the next sector over here, which will be real estate, XLRE. So real estate is clearly lagging the market as a whole. Its year-to-date performance is plus 0.46%, but definitely lagging the S&P and the overall QQQ technology sector. In terms of XLRE, it is performing the worst. Its 1 year period is down minus 24%. So let's just take a look at this particular sector. What is transpiring right now? Well, you've lost the 100, you've lost the 50, you've lost the short-term 20, you've lost the 200. You're just above the 7-week moving average. This chart is one of the more bearish charts. Yes, you're trying to recapture a short-term moving average, maybe build a base of consolidation to move higher, but there's tons and tons of resistance here. There's tons of powerful moving averages sloping down in bearish alignment. And when you have the 50 rolling down on you, when you keep getting rejected at this 200 after a wide range red bar impulse breakdown move, this sector has confirmed a major breakdown below the weekly 200 and is now what I believe just doing a simple retrace, and it should see more downside. If you can consolidate above this yellow moving average, the 7 weekly moving average, then you could have a move up to the 50. But I really don't anticipate much more upside in the near term for the real estate ETF. As long as it touches this 50 weekly moving average, I think that's going to be massive resistance. If you can somehow close above this wide range red bar breakdown and start consolidating above that level, then we can look to reassess for further strength. But as of now, this trend is looking very bearish. I mean, you've had this upsloping wedge pattern, which I've showed you in numerous sectors, including the S&P 500, the NASDAQ. You tagged resistance, sold off, broke the wedge, and now you're trying to do a retrace. But again, with this hard selling, breaking the weekly 200 and a variety of other moving averages in the near-term cluster here, that is not bullish. That is extremely bearish, and we have to be mindful of that. And this is all under the premise that interest rates have softened up in the near term. Yes, the market real estate has got a little bit of a bounce, but if the Fed keeps raising, and let's say the long and short-term yields have to move higher to close in the divergence from what the bond market and the Fed are producing, then we should see real estate see more and more weakness. And if rates have to stay higher for longer, that's certainly going to have a negative impact on the overall XLRE. Definitely there's some interesting plays that I'm keeping on watch there. A lot of weak names in this particular ETF. We are actually shorting a few with our members, but definitely a lot of relative weakness. Could it build a base and move a little bit higher because it is the most oversold sector in the S&P 500 as of now in terms of its 1 year performance? It absolutely could, but at this point in time, the trend is not your friend if you're long this particular ETF. And the big question is, are we starting to put in some potential bear flag consolidation? I mean, you have a beautiful range here where you can simply draw this potential bear flag that is on the near-term premise of breaking lower. And if you get a break of this channel, I mean, you're looking at a move down to at least probably about 29. Maybe you'll have a bounce at the double bottom, depending on how hard of a move you have down. But definitely piercing the $30 level is in the likely cards. And you could even see this major weekly gap around 28.15 that could be in the near-term horizon if the markets start to break much lower. Realistically, considering the S&P 500 has been performing relatively well off of the lows and this sector is lagging, you have to assume that if the S&P 500 sees more money flow coming out and more downside price action, this will also be a market trade and start to see more downside. Definitely relative weakness in this particular sector. All right, let's move along to the materials, XLB. Materials are going to be interesting to discuss because looking on the weekly chart here, materials may be on the verge of breaking lower. You're starting to put in this broadening consolidation pattern where you have a good move up into resistance, a little pullback, another higher high zone but rejection off resistance, another kind of a big pullback which made a little bit of a lower high in the trend over here, and now you're moving up, but it's finding resistance at that 100 weekly moving average again. So the big question is, if you get rejected inside of this wide range breakdown bar, you're likely going to make another low, or at least challenge these lows down here at 754. This broadening formation of consolidation is a clear sign of distribution. It is not healthy. When you have this type of broadening formation occurring at major resistance zones, and specifically when the markets have actually been performing positively, yes, the money flow hasn't been going into a lot of the larger and smaller cap stocks, it's primarily going to the mega cap, but the market as a whole, the S&P 500, the NASDAQ, has been doing well, and clearly this has also been seeing some distribution and potential downside. And the interesting thing about materials, in terms of its year-to-date performance, XLB is positive. It's just holding on to some positive gains, up 2.5%. In terms of its 1 year performance, year over year, it's down minus 9.65%. There is two inside patterns that's happening right now. So you potentially have a little bit of an inside bar bullish pattern starting. This is too premature to tell yet. 1 week of consolidation inside of this green bar is not enough. You need at least 3 or 4, maybe 5, 6 weeks of consolidation to potentially say that this is a bullish pattern forming. As of now, if you lose this wide range green bar low, this is in trouble. You're going to test this double bottom zone here pretty quickly. So the bulls want to see you hold this inside green bar reversal. The bears want to see you lose that reversal candle there. So that's one of the potential bullish patterns. The bigger bearish pattern is you're inside of this nasty sell-off. This wide range 2 week bar sell-off has heavy volume distribution, and it just so happens to be in a vicinity, this wide range red bar breakdown, where you had it over here as well. Look at these 2 week move down. Very similar spot on the chart in terms of resistance levels. So you have to wonder, is the same seller that was selling here just had this wide range red bar breakdown? And notice how at the point of the low here, you were on this major support trend line, and that support trend line became resistance. So that same seller that stopped the price action right here on the trend line is likely the same seller that is occurring right over here now, which is now resistance. It was support over here, you gapped over support, and that same seller is using that resistance trend line to sell and sell hard. And that was a heavy volume candle in terms of the downside move. So definitely be mindful that there is weakness in this particular sector that could continue to occur if the markets break down. Obviously, one of the reasons why some of the stocks that have been doing well in the materials like Newmont Mining has been outperforming, so that's been lifting the sector. Lind has a massive weighting in this particular sector. Let me just pull up LIN on my other screen to see. That's on the verge of a technical breakout. So when you factor in that a lot of the stocks in this particular sector, a lot of the big ones that carry a huge weighting have actually been performing well, and this particular sector still finished negative, that is a little bit of a relative strength and relative weakness divergence across individual names, which means that there's a lot of opportunity in this particular sector for long and short trades at the same time. All right, let's move along to the final sector, XLE. XLE is basically looking very strong at this point in time. XLE finished the week up 2.91%. XLE is on watch for a short-term technical breakout, and what I mean by that is if you draw a trend line, you can see you've broke that trend line over here, you've gapped over it, and now you're looking to confirm a breakout of the short-term trend line. Now, the short-term positive is you're back above the shorter-term moving averages, but you got rejected at the 20 over there, as you can see on the chart, and it did happen on heavier increasing volume. So there are sellers starting to unload in that off that gap up. The only reason this gapped up is because of the surprise OPEC announcement cutting oil demand by around 1.6 million barrels. So that's the only reason this gapped over resistance and is now trying to consolidate. Now, I still think this is going to fade and close this gap at the minimum. And then once it closes that gap, that's going to be the big test for XLE. Can the bulls and the oil price hold up, or will the economic deterioration of all the data we're getting start to send oil back to the downside? There's a lot of bullish momentum and bias starting to form in the XLE. Overall, there was a big announcement that happened on the weekend in terms of XOM potentially wanting to buy out PXD, Pioneer Energy. So that is a positive announcement for the sector, but it is kind of negative for XOM because XOM does hold a pretty big weighting in this particular ETF, and we just have to be mindful that if XOM offers them a kind of a maybe a deal that is a share on a share basis, that could be diluting the XOM current shareholders, which should act well for our overall short thesis on XOM as of now. But needless to say, we have to respect that oil's holding up. So as long as oil holds up, you should see the energy sector hold up well. And if you can get consolidation off this pattern, then you'll look to charge through these key resistance trend lines. But as of now, you can see you hit this key resistance trend line, major pivot over here, major pivot, your breakdown consolidation, rejection point, big cluster of resistance over here. You tagged it, got rejected. So that's the big level that you need to beat and close above. If you close above that, you have a second trend line going all the way down from your COVID or your October 20 lows over here, major pivot point. That's going to be your second big level. But needless to say, you did break that upsloping wedge pattern, and now you're just doing a simple retrace back to that potential pattern, and it'll be a big challenge in my opinion for the bulls to reclaim this, because one thing I keep seeing on a technical basis is this is still the big sell side pressure that came in energy, and we have yet to really confirm above this on a weekly basis for basically this whole consolidation zone. So it leads me to think that energy is still going to see more downside, especially once the or I have to say, especially since we see especially if we see economic deterioration or economic data continue to deteriorate in the near and medium term. I still think that the data that we're going to be seeing, although it's holding up in the jobs market, I think the industrial sector is kind of being a little bit of a leading indicator now. You saw like the likes of Caterpillar holding up so strongly in 2022, Deere as well, and just those leading stocks, those are very important names for the overall economy, and it does give us a little bit of an insight to potentially what investors are expecting over the coming weeks and months. And it's going to be interesting to see how energy and the price of oil hold up. Can the Saudis and OPEC really keep a bid under oil, or will the economic demand destruction from the Fed take hold at some point in time? Just keep in mind that we've only just had over 12 months since the first interest rate hike. So as of now, the interest rate hikes are slowly going to start to filter through the overall economy. And the big ones that the Fed did, the 3/4 basis point hikes, have still yet to hit the true economy, in my opinion. But that's coming. I do think that is coming. Overall, I'm going to be doing some extra videos in terms of breaking down individual stocks to see if there's potentially long and short trades. So just be mindful and aware that there will be a little bit of a new YouTube service that I will be offering in terms of trying to execute and find alpha. Basically, I'm going to be analyzing a lot of the individual names in all of the sectors that we just discussed. I have a short list of potential long trades, a short list of potential short trades, and I think there's going to be a lot of great opportunity in over this next quarter, where we're going to have a lot of capital rotation, a lot of continuation chop that is going to provide the savvy technical traders to capitalize on some quick near-term swings and pops, and specifically as we enter the earnings cycle. On that note, thank you all for tuning in. Definitely be prepared and ready for the extra videos that come out on our YouTube channel. Thank you all for tuning in, and we'll see you on the charts a bit later.